Hey guys, welcome back to the Capital Mindset Show. Today we're going to be talking about a company that was kind of a runner-up in the voting system for Discord. So if you guys want to join that community and have your voice heard, join down below. It's free. There's the filtration process you got to go through, but we'll see you on there if you want to join. All right, so taking a look at Carvana here, we're going to begin, of course, with the price action. We're going to discuss some of their competitors. So you can see that Carvana was a beneficiary of the pandemic. You saw that massive run-up, and now it is down about 80-ish% from all-time highs. We'll also take a look at Autonation. Autonation here is up decently. It's still benefiting from that. Shift Technologies, we're only mentioning this because of a large YouTuber that actually talked about the stock a lot when it was much higher. This goes to show how difficult this of a business this really is. It's heavily fragmented, meaning there's not a single competitor that controls so much of the market. The market is about $1 trillion in size, and the largest company, CarMax over here, controls about 2.2 to 2.4, and it's largest by market cap. Carvana was the largest by market cap not too long ago. Now CarMax here today is the largest by market cap. However, it has also fallen about 34% from its highs. All right, so really what we're going to begin with is looking at the presentation of Carvana, because that is the focus of our video here today. We'll look at the video, not video, but presentation as well by Autonation and kind of get an idea or feel for them. And we'll discuss some of the key aspects of these businesses that make it difficult or make it unattractive in some instances. So I'll say first, before we actually get into the presentations, anecdotally, I do enjoy the services offered by CarMax. I think they're very convenient. I think that that's the key focal point of something like Carvana, where they are essentially targeting those who are disillusioned by the dealership experience, and they don't like to deal with the what most people would consider questionable practices by dealerships. And so in that instance, Carvana is trying to take market share by being the easy to work with dealership. I will see how Autonation and CarMax actually solve that problem, because I guess they don't want to go bankrupt or they don't want to lose the entirety of their business model, or maybe they want to get bigger, right? They want to get larger. And if that is an opportunity, if that is a successful strategy, I guarantee you they're going to start to try to implement that as well. Now, the overall outlook of this industry is a little bit of a risk factor. The risk factor is that somehow, in some way, in some capacity, the larger vehicle manufacturers start to cut them out, okay? And this is not Carvana per se. Carvana is not having this risk. It's more Autonation and other dealerships. So if the car companies, they start to cut out the dealership model, which I think they should at this point. I think right now, so a little bit of context, the only reason why the dealership model is still even around is actually because government actually enforced it. So government it's not a free market thing. It's actually government enforces this dealership model, because there was actually a time when the car companies tried to go direct. And so they try to have that experience with the customer. Now, a rule of thumb in business is you always want to have control over your customers. You don't want to allow another entity to have necessarily control of the customer experience, because that doesn't allow you to have that full ability to control how that customer experiences your product. Now, that being said, there is a logistical nightmare should the car companies actually abandon the dealership model. There is a ease of mind that you can, basically run a leaner business, right? Tesla, for example, invested heavily, and it took a lot of investment, and there's still a lot of improvements to be made in terms of how their network works, the logistics and everything. But I think it is possible. It is a possibility. It's not an impossibility. Now, let's head over to the investor presentation and kind of get a feel for what it is that this company wants to offer us. And this is the sales pitch, so we got to remember that. So taking a look at the retail units sold, it is growing rapidly. Very impressive there. But we have to remember the pandemic might have brought forward a lot of demand. Revenue in the same instance has grown tremendously as well to $12.8 billion. Very good. All right, so markets sold at year end. Okay, so that's growing too. We want to see that. Car vending machines, this is their expansion. There's actually a couple, there's actually one in my city, so... let me know if they're in your city, but these are really cool things. It's literally a vending machine of cars. Gross profit margin gross profit per unit back in 2016. I actually remember this. They were just passing the $1,000 mark, and now they're in the $4,000 mark. So if they're selling basically these used cars, they have to make a profit between the delta of what they buy it, repair it, and then sell it for, if they repair it, if it needs repairs. Net income and EBITDA margin. So EBITDA margins back in 2016 were negative. They are approaching positive. This is very important, and we'll pay attention to the EBITDA margins, because the EBITDA margins, that's the operational margins. Now they're just basically at 0%. They're just breaking even. This needs to improve better, but maybe the market is actually not believing believing that that's going to be the case. I think it is possible. I think they're showing that they're reaching that critical mass point of scalability. So the fact that this is going up in a positive direction shows me that the business is scaling. Okay, so that's very important to take note of. All right, so growth, fastest growth. Okay, cool. This is this thing that is always passed around in a lot of their presentations. I think it's really important to actually keep an eye out. You might see this if we go over their letter to shareholders as well. But this is their like flywheel effect. So more sales leads to more ICRs. Okay. More ICRs leads to cars are closer to customers. Cars closer to customers equals shorter delivery time. That equals more sales. And then more inventory equals more sales. So this is their business model. If you understand this, you pretty much understand how Carvana functions. And I think that this, again, they're not going to feel that if the other car companies, for example, cut out the dealerships. There's always going to be room for those dealerships to buy the used cars, right? Buy and sell used cars. And actually, Carvana actually acquired an auction company for about $2.2 billion in order to kind of expand its network. I think Carvana by far is the most aggressive and innovative of the car dealerships. So they are really pushing hard, and they have the benefit that they don't have that legacy reputation of being a dealership, right? So, you go to one of these other traditional dealerships, already the consumer data shows that the consumer is a little bit hesitant, already has kind of a bad taste in the mouth, is expecting to get shafted in the transaction. And that's not necessarily a good thing, especially when you consider the car manufacturers, how they want their customers to feel about their car. Imagine that, let's say Chipotle wants you to come and eat at their restaurant, but, for some reason, and they know this, by the way, and it's like common knowledge that when you go to Chipotle, you feel like the guy in the line is going to shaft you with the chicken. Right. And then everyone feels that way. And it's like a known thing that the chicken, you're just not going to get that much chicken. So Chipotle definitely doesn't want you to feel that way, because then that translates to less sales. Okay. So kind of expanding upon the same idea, we actually can look at this number of markets above market penetration milestones. So this is their market penetration that they're actually trying to grow and grow and grow. And it seems like it's working. This is quarterly retail unit sales, growing. So very nice chart here. Very nice chart. This will all be important for when we actually model it all out. And then we're actually going to go here to the shareholders letter, and actually we can see the up-to-date information. Cash from operating activities, we do see that cash flows are actually negative still, and even net loss of 500 million right there. Okay, so let's take a look at the balance sheet. How healthy are they? So just on a preliminary look, let's look for that debt, long-term debt. So they have some debt there, and cash equivalents. They are a little bit light on cash versus their debt amount, but it's fine, because supposedly the vehicle inventory, that they're going to sell that, right? So that's probably why they have so much debt. They have to take on that debt to purchase all these vehicles, and they need vehicle inventory because that's, again, their business model. Okay, so over time, as the inventory kind of matures, it's going to be kind of like a lagging indicator. So the problem, though, and this is my concern, this is my main concern, if current used car prices are not sustainable and the consumer is going to suffer, then this is definitely a very risky move that Carvana is probably undertaken. Perhaps they were too aggressive in buying cars. And that is a very real possibility and a very big concern of mine. And that could hurt the company quite drastically. In fact, to a degree where I think something like a Shift Technologies might actually go bankrupt from that. Carvana, I don't think might go bankrupt, but could get hurt a lot. And then something like Autonation and CarMax would be almost kind of fine, because they're not going to be as aggressive in that front as Carvana would be, or something like Shift Technologies. So that's kind of my preliminary thoughts on that front. Let's actually go to the Autonation investor presentation and kind of get another feel for a competitor. And total revenue, you see it's out there benefiting. We're going to kind of go through this a little bit faster, because I'm just only looking for the stuff that we really care about. So this is the makeup, and we have to also understand these traditional dealerships, they also sell new cars. They have partnerships with these brands. And you can see here that these are the brands that Autonation has dealerships in, basically all of them at this point, except for Tesla. And do they have, no, they don't. Yeah, they don't have that. Okay, cool. So I was looking for Volvo. I don't see Volvo here. So Volvo also, has the Polestar brand, which is, you can order from online. So it's pretty convenient. Diversified revenue mix, profitability, okay, finance. Again, remember how fragmented this business is, okay? So Autonation USA provides footprint. And so this is like them highlighting the benefit of a dealership model. So they say provides opportunity to expand geographic footprint, leverages experience. So, and this is their rollout plan, by the way. So they want to roll out these buildings, okay, and just put them all over the place. And the more stores, more customers. That's basically what they're saying. All right, from there, we're kind of done. So let's actually look at Autonation's sales. So they are actually positive net income, and it's growing. But you got to be careful with the numbers. We want to know or understand that prices are pretty crazy for where they are right now. And then cost of sales, you can see this. So new vehicles, so take a look at this. If you ever wondered, we can actually look at this together. So a new vehicle would sell for, let's say, 12, and then the cost of that new vehicle is 10.8. So then that leaves about 1.2 in the bottom line. And then let's take a look at the used vehicle cost of 7.9, used vehicle sale of 8.6. That does imply that the used vehicle in a percentage terms is better, okay? It does imply that a used vehicle is better. And then parts and service, let's see, parts and service 3.7. Yep, that is the most profitable segment. So that is where they shaft you. No, I'm kidding. But that is where they get most of their money. It's actually not from selling these new vehicles, okay? If you didn't know that, now you know. Okay, so now you know. And then so the total revenue is about 25 billion, and we can see how this is kind of expanded. This is kind of like their cash cow. They love this. And this is actually a bit of a concern as the world moves to electric. So this will be a little bit of a concern, but you can see it's not the total business line. So as long as they can still sell new vehicles, they'll survive. As long as they can still sell used vehicles, they will survive. Okay, so then total cost of sales, they've generated about 5 billion after cost of sales. Okay, so now, oh, that's cool. They break it down here. I was doing the math and I didn't even need to. It's right down there. So yeah, you can see here that even parts and services as gross profit is the highest in gross profit total, and as a percentage, it's ridiculous. Okay, so if you didn't know, there you go. But you have to calculate this as a percentage of what that is, by the way. So actually, the used vehicle isn't actually that much more. Okay, so the new vehicles and used vehicles is fine. Traditionally, this is actually better. So traditionally, used vehicles were better as a percentage, and more recently, this is probably because of the situation that we're in. Financing and insurance, pretty good. Okay, and then let's actually go to the balance sheet to kind of get a feel. Oh, that's the netting. We're back to the income statement. We're trapped at the income statement. Here it is. So inventory, again, is actually declining. Okay, so while Carvana's, I believe, let's actually return to Carvana. Carvana inventory is rising slightly. Okay, so rising slightly versus declining. And again, I'm going to be cautious on that exposure there, but I want to see the long-term debt. Okay, so long-term debt, current liabilities, commercial paper. Well, that's a little bit there. I don't see any long-term debt, but they do have some debt. That's not. Oh yeah, there it is right there. Okay, so 2.8 billion. In terms of cash, they have 60. So a little bit light on cash, but something happened here. They really expensed a lot of cash through 2020 to 2021. Probably I don't know what they were doing here. That'd be interesting to see what it is they were doing. They probably maybe did an acquisition or something, unless it went into. No, it didn't. No, they don't have any other forms. All right, yeah, current assets really did take a hit there. Long-term debt, actually is declining too. Well, no, sorry, current liabilities is declining here, but long-term debt is increasing. So they actually took on more debt, but current liabilities went down. All right, so it's fine. It's fine. Revenue, okay, so I want to see the cash flows. Last thing we're going to look at, and then we're going to actually plug this into the model, get a valuation, a feel for Carvana. But yeah. So cash flows provided by continuing operations, 1.2. Okay, so that's fine. Yeah, that's fine. So 1.6 billion and purchase property. So they are cash flow positive versus something like Carvana. So that's interesting to note. Versus each other, the legacy company, it's considered to be safer in that aspect, but Carvana is the faster growing one. So with that being said, let's actually plug it into the model and see what we get. All right, right here at the model, we're going to actually plug it in, CVNA. All right, let's see what we get there. There we go. So we are going to do an unprofitable analysis. Autonation has about 11, 12-ish%. I'm going to say they actually achieve a 9-ish% there. And reason why is because they don't have the other business segments necessarily that Autonation does that are very profitable. So they're mainly dealing with the buying and selling of vehicles. And so we're going to keep it at a lower rate, and then maybe they can improve that going forward. But I'm going to say that they achieved that at year 5. So 5 years from now that they can achieve something close to that. And then that's going to be averaged out. So that's the averaging out of it. So taking a look at what we can kind of see here today, I think that let's see the share dilution. Okay, share dilution has been pretty strong if you ask me. And so we are going to assume some form of share dilution. I'd say let's maybe be a little bit less aggressive and say 4%. So if they can grow and actually look at that, revenue actually is estimated by analysts to come and crash down back to trend line. Cash flows are expected to grow above trend line, but revenue is expected to come crashing down. And so that actually can make sense if you think about it, because this is a leading indicator of this. So this is 2021 affecting the estimates here. And so that's interesting to know. What I think right off the bat is I'm looking at a company that does have to expect a tremendous amount of growth. So I would be a little bit cautious on this business. I think that the business is interesting. This would automatically go into my speculative bucket because I think it has a lot of potential. It's a difficult one to kind of map out where it's going to go from here. Determining what it will grow at in the next 10 years is very questionable because of one key distinct point. What happens if the consumer, used car prices can't maintain themselves at these rates? Ask yourself that. If it's not sustainable, if you think that's not sustainable, then the inventory levels in something like Carvana are going to be quite dangerous because they bought a lot of those cars in these crazy years, right? And so the current value of that inventory may not be as valuable as you might think. And sometimes, and the difficulty with this is the longer it actually remains on inventory, a lot of cars, not all cars, but a lot of cars, the longer it remains on inventory, that year actually causes the value of it that a consumer is willing to pay for it to come down. And remember that we continuously build new cars, right? But right now we are going through a little bit of a supply crunch regarding new cars. So that's to their benefit. That's kind of what's saving them. But I'd be very cautious. And that goes for all of these, specifically though Carvana and something like Shift Technologies. CarMax and Autonation, not as much. Autonation probably less so, I think, because I think they're pretty well run from what I can gather. But we'll actually plug in Autonation here. So if we do AN, and we're not going to do an unprofitable analysis, so we're going to say no to that. And let's see. Okay, so it's plugged in, and we have a price target of 108, implying an 11.86% downside. Now, here's the thing. I think that growth is actually going to decline. Again, lagging indicator there. Shares are actually coming down, though, so I want to actually give them the benefit of that and say, okay, you can buy back about 7-9% of your shares. So now, what it does imply, I actually would caution you on saying that you don't think it's going to decline. I think a decline is pretty possible at this point. And I think negative 5% from these highs is potential. Actually, I'd put it here. And then this one, I'd put it like, let's put it at a 0%. See what kind of that pencils out, and 10% there. On the higher ends, I think you can grow probably like 10 to... On highest end, I think 15% is probably where it could go. And I actually weighted at the lowest rate. So basically what it implies is it's incredibly cheap. And I would actually argue that it is cheap. I think Autonation is a cheap stock on the surface. And taking a look at the PE, price free cash flow, 5 and 5.24. Okay, why is it so cheap? Well, consider these risks. Again, what happens if the auto manufacturers, again, push really hard this time to kind of move around the dealership network? Now, the dealership network, a lot of you might be saying, well, that's impossible. Well, consider maybe, are you biased in some way? Because I'll tell you, I personally, I've kind of made a statement that I don't want to deal with a dealership ever again. I would go out of my way to not deal with a dealership. And that's something that Tesla kind of acknowledges, and that's why they don't use a dealership network. They refuse to actually use the dealership network. They want to deal with the customer directly. He who controls the customer controls the business. So it does have a strong buy forecast rating by analysts, though. So, that's all you need. I'm kidding. And very good return on invested capital, very good return on equity, very good return on assets. Now, all of that being said, just the other time frame, it was trading at almost book value. So it was cheaper before. I think this market actually pushed it up. So again, I'd be more on the cautionary note more than anything, that it looks and it appears cheap, but remember the nuances of investing. In this instance, the market might be telling you that, okay, it's cheap right now, but going forward, you know, the consumer might not be as strong as it was or as it's believed to be. And then that is what the price is telling you here, right? It's not free money. It's not, oh, it's a PE of 5 or a price free cash flow of 5. Cheap, buy, you know? No, perhaps there's something concerning under the hood going on. And we might actually see some level of decline, in fact. And, you know, it could be that we are on this high point, and that's where the cash flows are kind of there. Take a look at where it was before. Previously, the cash flows were much lower, right? All of a sudden, this massive jump. So this decline right here, I'd actually weight it at the higher echelons. So -5%, absolutely. I'd weight it at 60-ish%. It could even decline further than this. Actually, some might say that it should be -5 and then -10, and even like something close to a -12 to 15. Let's just see -15. So even then, the model before wasn't even liking it, so it wasn't really telling me to put any capital allocated to it. But yeah, sentiment, let me see. Oh, there's no sentiment score. No one really talks about this stock, but let's take a look at how the management team's paid. All right, so yeah, look. How many zeros do you have behind your paycheck? No, I'm just kidding. All right, so yeah, about 1,870,000. Cool. 1.8 million, 1.5 million. All right, cool. All right. So that pretty much covers these car companies. If you guys like this video, go ahead and feel free to leave a like, subscribe if you're not subscribed. And if you guys found any value in this video, you know, let me know down below. If you have any questions, feel free to actually stick around for the live stream that is coming out tonight. Well, actually, forget that, because this video might come out the day after the live stream. I have no idea. But on that note, guys, thank you guys so much for watching. I'll see you guys in the next one. Bye.